Here's the move they made. Overnight, the exchange raised margin requirements on silver futures by 50% instantly. No easing into it, no adjustment period. Holding silver positions suddenly required far more capital than it did just hours earlier. That wasn't a technical update, it was a pressure play. Margins are how the exchange controls behavior. Raise them sharply. And you don't need people to choose to sell, you force the issue. Positions that were fine yesterday become dangerous today. The objective was clear. First, force liquidation. Push leveraged traders out whether they want to leave or not. Second, a long squeeze. Falling prices trigger more selling, which pushes prices even lower. And third, psychological damage. Hit confidence late on a Friday, when people don't want to hold more to the risk into the weekend. This timing is deliberate. When traders see margins raised, memories kick in, past crashes, old pain, the assumption that history is about to repeat. Most don't wait for confirmation. They sell first and ask questions later, and in the past, that reaction was enough. Markets usually fold under this kind of pressure, selling accelerates, liquidity vanishes, charts break, the story writes itself. That's why this moment matters, because the rule change landed, the pressure hit, silver dipped, and then it stopped. No cascade, no collapse, no panic spiral. The selling didn't snowball the way it was supposed to. The market absorbed the hit and stabilized. That's the part most people overlooked. The exchange pulled out one of its strongest tools. The move that has ended rallies before. The mechanism designed to shut things down. And this time, it failed. When a move like that doesn't work, it's not random. It means the pressure is hitting the wrong hand. It means the market underneath isn't as fragile as it used to be. What looked like authority was actually urgency. What looked like control was actually stress. And once you see that, the focus shifts. Because the real story isn't what they change, it's why the change didn't break the market. When something like this happens, history is the first weapon people reach for. They look back and say, we've seen this before. They say it happened in 1980. They say it happened again in 2011. And they say it always ends the same way. In 1980, when margins were raised aggressively, silver didn't hesitate. It collapsed nearly 50%. In 2011, the same tactic was used. Margins were hiked repeatedly, fast and hard, and silver lost about 30% in a single week. No fight, no pause, just straight down. That memory lives deep in the market. It's why the moment people hear the word margin, their bodies react before their brains do. It's muscle memory, trauma memory, the instinct that says, get out now before it's too late. And that's exactly what this move was meant to trigger. But here's the detail that breaks the pattern. Today didn't follow the script. The margin was raised, the pressure hit, the price dipped, and then it stopped. No waterfall, no collapse. No follow-through selling. Silver didn't cave. It held its ground. That's not normal, and it matters more than people realize. In the past, when this lever was pulled, the market folded because it was built on leverage and belief. Once belief cracked, there was nothing underneath to catch the fall. This lever has a name. Traders call it the margin nuke. It's the strongest tool the exchange has. You don't argue with it. You don't negotiate with it. You pull it, and positions die. That's how it has always worked. Until now. Because a margin nuke only works when the market underneath is fragile, when buyers are speculators, when demand disappears the moment pain shows up, when ownership is temporary. That's the quiet difference people miss. In 1980 and 2011, silver was owned by people who planned to sell it back. Today, a growing share of silver is owned by people who plan to use it, consume it, lock it away, remove it from circulation. That changes everything. This is where the moment becomes bigger than charts. In real life, when pressure hits something hollow, it collapses. When pressure hits something solid, it reveals strength. The same stress that destroys one structure hardens another. That's what you're watching. The market was hit with the same weapon used in the past. Same force, same intent, same fear trigger. But the reaction was different because the foundation underneath is different. And that's why this isn't just about silver. It's about how systems behave when they're no longer aligned with reality. When the tools that used to work start failing, when control requires more force, not less. The margin nuke was supposed to end the move. Instead, it exposed the fact that the rules still changed, but the outcome didn't. And when history stops repeating itself, it's usually a sign that something fundamental has already shifted. To understand why that pressure move mattered so much, you have to understand the arena where it happened. Most people think silver trades the way real things trade. Someone buys, someone sells, metal changes hands, price moves. Simple. That's not how this market works. The price most people watch doesn't come from people swapping physical silver. It comes from COMEX, a futures exchange. And COMEX doesn't behave like a warehouse. It behaves like a casino. On COMEX, you're not buying silver, you're betting on silver, you're trading futures, contracts, paper promises that represent silver, not metal itself. And the key ingredient that makes this casino work is leverage. Here's what that means in plain English. Until very recently, if you wanted exposure to 5,000 ounces of silver, you didn't need to pay for 5,000 ounces. You didn't need hundreds of thousands of dollars. You only needed about $12,000 in margin. That's roughly 25 to 1 leverage. With a relatively small amount of cash, you could control a massive position. Hedge funds, day traders, algorithms, everyone plays this game. It's why prices can move fast. It's why rallies feel explosive. Leverage turns small moves into big ones, but leverage cuts both ways. When prices rise, leverage feels like rocket fuel. When pressure hits, leverage becomes a trap, because that $12,000 isn't a purchase, it's a performance bond, a promise that says, I can cover the risk. And the exchange decides how big that promise needs to be. That's where the control comes in. COMEX doesn't need to argue with traders. It doesn't need to predict the market. All it has to do is change the cost of staying in the game, raise the margin, and suddenly the table gets more expensive. Imagine sitting at a blackjack table where the dealer says, same hand, same cards. But if you want to keep playing, I need more money right now. That's leverage. And that's why margin hikes are so powerful. They don't care if you believe in silver. They don't care if you're right, long term. If you can't post more cash, you're out. Your position gets closed automatically. This is why COMEX is a casino. Not because it's fake, but because it's built on bets layered on bets, amplified by borrowed exposure. Most players aren't there to take delivery. They're there to flip paper to the next person. And here's the part that matters. A system like that works beautifully when confidence is high, but it becomes fragile when stress enters the room. Leverage magnifies fear the same way it magnifies gains. That's why the exchange reached for margins. That's why it expected the market to fold. That's why, in the past, it usually did. But as you're about to see, this time the pressure didn't land where it used to, and when leverage stops being the dominant force, the entire game starts to change. Once you understand leverage, the margin nuke becomes easy to see. And once you see it, you can't unsee it. Here's the mechanical part most people never think about. Before the rule change, controlling a silver futures contract required about $12,000 in margin. One contract represents 5,000 ounces of silver. That was the buy-in. That was the cost of staying at the table. Then, overnight, the CME raised that requirement to $18,000 per contract. Same position, same exposure, same risk, but suddenly, the price of staying in the game jumped by 50%. Now picture a real player, a hedge fund, holding 1,000 contracts. Nothing exotic. That's a normal size position in this market. Yesterday, that fund needed $12 million parked at the exchange. Everything was fine. Positions were open, risk was managed. Then the clock rolled over at around 2:00 a.m. The exchange effectively says your buy-in just changed. You now need $18 million on deposit. Not tomorrow, not next week, now. You get about 1 hour to wire an extra $6 million in the middle of the night, while banks are closed, while decision makers are asleep, while liquidity is thin. Most funds can't do that. Not because they're insolvent, but because cash doesn't move instantly at 2:00 a.m. And this is where the chain reaction begins. If the money doesn't arrive on time, there's no debate, no negotiation, no discretion. The exchange's system starts closing positions automatically. Contracts are sold at market prices, not because the fund wants to sell, but because the rules demand it. This is forced selling. It has nothing to do with belief, nothing to do with fundamentals, nothing to do with long-term conviction. It's mechanical. One forced sale pushes the price down. That drop triggers margin stress for the next account. That account gets liquidated. Price drops again. Fear spreads. Other traders panic and sell preemptively. That's the cascade. That's why it's called a margin nuke. One rule change sets off a chain reaction that looks like organic selling but isn't. It's a system eating its own leverage. In everyday life, this happens more often than people realize. It's like raising the rent overnight and then acting surprised when tenants leave, or changing the rules mid-game and blaming the players for not adapting fast enough. The key point is this: the margin nuke doesn't test who's right, it tests who has cash right now. And historically, that's been enough to break silver. The market was built on leverage, remove the leverage, and the structure collapses. That's why this move was expected to work. That's why it has worked before, which makes what happened next so important. Because the selling started, the pressure hit, the mechanism activated, and yet the chain reaction stopped. When a machine designed to force selling fails to force a collapse, it tells you something profound about who is still standing on the other side, and that's where the story turns. To understand why this move was supposed to scare people, you have to go back to 2011, specifically Sunday, May 1st, 2011. Osama bin Laden had just been killed. The news cycle was chaotic, emotions were high, and silver was on fire. Prices had just touched $49.50. It felt unstoppable. The move was vertical. Confidence was everywhere. Then, quietly, the rules changed. Under cover of darkness, the CME raised margin requirements. Not once, not twice, but 5 times in just 9 days. Each increase tightened the vice. Each hike demanded more cash. Each one forced more selling. On Monday, silver dropped about $5, then margins went up again. On Tuesday, then Wednesday, again, and again. By the end of that week, the message was clear: stay in this trade or get crushed. It worked. Silver collapsed from $49 down to $33. Billions in long positions were wiped out. What followed wasn't a quick rebound. It was a bear market that lasted for years. That experience burned itself into the collective memory of the market. People didn't just lose money, they lost trust. They learned a lesson the hard way: when margins rise, silver dies. That belief became instinct, muscle memory, trauma, and that's exactly what the exchange is relying on now. They want you to see a margin hike and feel 2011 in your bones. They want your body to react before your mind catches up. To look at today's chart and think, I've seen this movie, I know how it ends. That's fear conditioning. But fear only works if the environment is the same. In 2011, silver was owned mostly by speculators. Paper demand drove the rally. When leverage was pulled, there was nothing underneath to support the price. Once the selling started, it fed on itself. The margin nuke didn't just work back then, it dominated. Which is why this memory matters so much. Because when a system leans on the same weapon again, it's telling you something. It's telling you it expects the same reaction. And the real question now isn't whether they raised margins. It's whether the market you're in today is still the same one that existed in 2011. That answer changes everything. This is where the story flips. In 2011, silver moved because of paper demand, futures contracts, ETFs, options, trades built on leverage and belief. People bought silver because they expected to sell it back later at a higher price. Ownership was temporary, fast money. That structure mattered. When margins went up in 2011, paper demand vanished, speculators were forced out. There was no real-world shortage underneath to catch the fall. Vaults were full, supply was available. Once leverage disappeared, so did the price. That's not the market we're in now. 2025 is driven by physical depletion. This rally isn't powered by traders chasing charts. It's driven by users who actually need the metal, industry, infrastructure, nations securing supply. Buyers who don't care about margin rules because they aren't using margin at all. The numbers tell the story. Today, the silver market is running a 1.1 billion ounce deficit. That's not a forecast, that's reality. More silver is being consumed than produced. Year after year, the vaults reflect it. Inventories are thin. Some are effectively empty. Metal that used to sit quietly in storage is gone, pulled forward, locked into manufacturing, removed from circulation, and it doesn't come back. Refineries are another signal. When refineries slow or halt, it's not because demand disappeared, it's because supply can't keep up, or inputs are constrained. That's not a paper problem, that's a physical one. This is the difference that changes everything. Paper demand reacts to fear, physical demand reacts to necessity. In 2011, when fear hit, buyers disappeared. In 2025, when fear hits, buyers step in. Because a factory doesn't care about a red candle, A government doesn't care about a weekend chart. A supply chain doesn't stop because margins change on a futures exchange. You can raise margins on paper contracts all you want. It doesn't create new metal. It doesn't refill vaults. It doesn't restart refineries. It doesn't solve shortages. This is why the margin nuke didn't land the way it used to. The weapon hasn't changed. The battlefield has. In 2011, silver was a trade. In 2025, silver is a resource. And when something becomes essential, price behaves differently. Not emotionally, not explosively, but stubbornly. It resists. That's why the market didn't collapse. That's why it held. And that's why the old playbook no longer delivers the same ending. Once you understand why 2025 isn't 2011, the next piece snaps into place. What you just witnessed wasn't a breakdown. It was a bear trap. A bear trap is when price is pushed down just far enough to scare people into selling, or even shorting, right before the market turns against them. It looks weak, it feels dangerous, and it plays directly into human instinct. Here's how it works in real life. The price dips below a level everyone is watching. In this case, around $64. Screens turn red, headlines start forming, social feeds fill with panic, retail traders react fast. They sell to protect profits. Some go further, they short, convinced the real crash has started. From the outside, it looks like smart risk management. From the inside, it's predictable. Because while retail is selling in fear, someone else is buying with intent. Ask yourself the most important question in this entire move. When silver traded around $63, 80 who was on the other side of that trade. It wasn't another nervous retail trader. Retail doesn't step in on red candles. Retail steps away. The buyers were algorithms, executing preset orders without emotion. They were industrial buyers who don't trade charts but secure supply. They were sovereign entities, thinking in years, not weekends. These buyers weren't reacting. They were waiting. They knew the margin pressure would flush out weak hands. They knew panic selling would appear right on schedule, and they placed their bids exactly where fear peaks. That's the trap. Ownership quietly changed hands. Not from smart to dumb, but from temporary holders to permanent ones, from people who plan to flip silver, to people who plan to use it, store it, or lock it away. Once that transfer happens, the market changes character. Weak hands are gone, leverage is reduced, the selling pressure exhausts itself. And when price turns back up, the people who sold panic. The people who shorted get trapped. They have to buy back at higher prices, adding fuel to the move they thought they were betting against. This is why bear traps are so effective. They don't punish ignorance, they punish impatience. And the deeper truth is this: every major move begins with a transfer. Assets move from those who need liquidity to those who don't, from fear-driven decisions to necessity-driven ones. Once you see that, the confusion disappears. What looked like weakness was actually a handoff, and the market never feels the same after that happens. Here's what most people never see. While price is flashing red on screens, another market is operating quietly underneath. No charts, no candles, no headlines, just orders waiting. This is the shadow order book. In the physical silver market, massive buyers don't chase price. They set rules and wait. Standing instructions, preloaded demand. They look like this. If silver drops below $64 by 1 million ounces, if it drops below $63 by 2 million ounces, automatically. These aren't traders. These are procurement desks, corporations like Samsung, Tesla, First Solar, buyers who don't care about Friday candles or margin rules. They care about one thing: securing supply before it disappears, because they know something retail doesn't. Once they buy silver, it's gone, melted, built into products, locked into solar panels, batteries, electronics. That metal never comes back to the market. This isn't trading, it's consumption. That's why every dip now feels different. The moment price slips, it hits a wall. Not because of optimism, but because of necessity. This is why the floor keeps rising. Every scare transfers metal from weak hands to permanent ones. The float shrinks, the market tightens, paper selling meets physical demand. And physical demand doesn't blink. Now the timing makes sense. Why did this happen on a Friday? Because weekends are dangerous for control. The COMEX closes Friday afternoon. For nearly 48 hours, the paper market goes quiet. No Western price management, no margin games, no tape painting. But the world doesn't stop. Asia opens, China, India, the Middle East. If silver goes into the weekend strong, It sends a message the West can't control. It tells Asia the paper price is losing authority. That's why the banks needed the chart to look weak. A red candle, a long wick, anything to suggest exhaustion, that's what painting the tape means. But here's the problem. By pushing price down on Friday, they didn't scare Asia. They put up a sale sign. Asia doesn't read this as strength. It reads it as urgency, as a system using tricks instead of supply. And when Asia sees discounted silver going into the open, it doesn't hesitate. That's why Fridays matter, and that's why weekends are where momentum quietly shifts. So what happens when the margin nuke fails? The regulators only have two cards left. The first is position limits. Cap how many contracts one entity can hold, frame it as fairness. Force large holders to sell, create pressure. The second is more extreme liquidation only mode. No buying allowed, only selling. That's the nuclear winter option. If they do it, the paper price can crash. $50, maybe $40 on COMEX. But here's the catch. The buyers don't disappear. They just move. They go to Shanghai. They go to London OTC. They go straight to physical dealers. And that's when decoupling happens. COMEX silver at $40. Physical silver at $90. A $50 spread. At that point, no miner sells to COMEX. Why would they? Vaults drain. The exchange becomes a zombie market. Paper trading paper with no metal behind it. That's the trap regulators are in. Do nothing and price runs. Intervene too hard and they destroy the market they're trying to control. Now zoom out. This was never just about silver. It's about paper reality versus physical reality. Paper says silver is risky. Physical reality says silver is essential. Paper promises are infinite. Metal is not. The dollar is broken. Debt keeps growing. Printing never stops. And when systems weaken, they try to shake confidence instead of fixing supply. That's what this week was. A conviction test. Did you panic? Did you sell? Or did you recognize a discount? Here's the setup now. Shorts added positions around $63.50. Price is above $64. They're already trapped. Over the weekend, shortage stories spread. People try to buy. Supply isn't there. When markets reopen, pressure flips. A gap up to $65 or $66 on Monday is entirely possible. And once that happens, exits disappear. Covering fuels the move. This all happened on Friday, December 12th, 2025. The banks fired their best shot and it missed. 1 ounce is still 1 ounce. And in a world of scarcity, value doesn't ask permission. The old rule was control through paper. The new rule is supply. And in the end, it comes down to this. He who holds the metal makes the rules. Stay calm, ignore the noise, and let the system show you what it's afraid of.